Good evening to anyone out there. My name is Andrew. I'm a former risk manager, a current quant developer, and a part-time financial analyst. And look, there are a number of topics that I'd like to talk about over time on this channel. How to measure risk, what is diversification and how do I achieve it? How do I assess my portfolio? Maybe I should even do a risk review of other popular YouTubers' portfolios, or even one of my own. If you're interested in any of these topics or others, please let me know in the comments below. But for today, there's one topic that I really don't hear talked about on YouTube, or quite honestly, not even in many of the funds that I've worked at over the years. And that is, how do I size a trade? How do you allocate your capital across different trade ideas that you have? Now, this ties into the concept of portfolio optimization, which is very technical, both heavy math and heavy computer science, and I'm not going to get into that here. But let's just say that you'll define your optimal portfolio as one that gets the best return per unit risk. Now, the return is easily defined. Unit risk would be defined as your volatility over some time period. And in the asset management world, you'd call this your Sharpe ratio. I'd be happy to elaborate on any of these concepts later if you wouldn't find it too boring. So please let me know if that's the case. But suffice it to say that most investors, professional or otherwise, tend to measure their portfolio performance against a benchmark. The thing I most commonly hear is, I would like to beat the S&P 500. But there are a number of other companies out there that you might want to track. There's the Russell 1000, there's the Wilshire 5000, et cetera, et cetera. Now you're probably thinking, I'm not out here to invest in an index. I want to pick individual stocks. How does this apply to me? But I think what's important to realize here is that what I'm about to outline is really the methodology used by the vast majority of mutual fund managers out there today and many other financial advisors. So this has trillions of dollars behind it, and it can be used as a framework about how to think about your own portfolio. So the most common way to ensure that you track performance of your benchmark is to really just invest in the index and make small tweaks. This is known as underweighting, when you tweak it to invest a little less in one company, or overweighting when you put more capital in than the benchmark would otherwise suggest. This is to reduce what they call tracking risk, which is the deviation between your portfolio's return and the index return that you're tracking. But even under this, you're mostly relying on the benchmark to tell you how to allocate trades across different equities. So your benchmark defines both the universe of stocks that invests in, your list of equities, and also how much should go into each. And that we'll call the weight. And the weights of all your equities should sum up to 1. And then if you take these weights and multiply them by the amount of capital you have to invest, that tells you the number of dollars that you need to invest in each individual stock. You divide that by your share prices, and there you go. You have the size of your trade. If you're on a platform that allows fractional share ownership, your job's done. And if it's not, well, you have to do a little bit of mathematical finagling to get down to an even number of shares in each stock that you want to buy. But the important part here is that the benchmark provides the weight of each stock. And there's usually a well-defined methodology for that, how that happens, because these weights change each and every day. If we look at the example of the S&P 500, it uses what's called a cap weighting scheme, where it takes the market cap of each individual name and then determines the weight in the benchmark as the market cap of that name divided by the total market cap of all of the stocks in the benchmark. So there's some implicit bias in this, and that is a heavy bias towards the largest of large cap stocks. For example, every dollar that you invest in the S&P 500 implicitly invests almost 7 cents in Apple, but only about 1/100th of a penny in Xerox. And this is how most indexes and most ETFs, your SPY and the like. That's how they allocate their capital. And odds are you're invested in some index or some ETF that allocates this way. I know I am, at least in part. Now, there's another weighting approach that's pretty common. Well, maybe not as common, but certainly has a lot of lineage behind it, and one that you hear every day, and that's the Dow Jones. Their approach is a little bit novel and leads to other weird, skewed behavior in their portfolio, and that is what's called a price weighting scheme. Now, implementing this is super simple. You think of all of the names of the securities, all the securities that you want in your portfolio, and pick a number of shares, and that number of shares you buy in each of the securities. So looking at the Dow, you'd have just as many shares of Apple as you would of IBM. By that standard, you'd have almost the same amount of capital in IBM as you would in Apple today, because they have very similar share prices. Even though Apple is more than 10 times larger than IBM, and arguably has a lot more growth opportunities too. But that's kind of besides the point here. Now, in my own portfolio management journey, I haven't followed either of these approaches really. I think they lead to very suboptimal portfolios. It's been proven time and time again that the S&P 500 specifically is a seriously takes a lot more risk per unit reward than is needed. It falls way outside of what is called the optimal, what is it? I forget the terminology offhand, but let's just say that you can do much better. So one way that's been proven to be better than the S&P's default weighting is to equal weight. That is, divide the amount of capital you have by the number of stocks in your portfolio, and then each stock gets the same amount of dollars into it. Now look, there's not any real easy answers to determining how to weight your individual trades. And to be honest, the best answer is probably to use a portfolio optimizer. It's a very customized piece of software that either you're writing yourself or you're buying for quite a high price. But these approaches that the benchmarks use and that the mutual funds and the like use are worth thinking about, because ultimately it comes to, when you think about a new trade, how do you figure out how much money to put into it? Do you look at the highest possible payoff? Do you actually think about the riskiness of the portfolio and use that to adjust how much money you put in? Do you do like the S&P does and say, I feel safest and put the most money in the largest companies? Or do you do some sort of inverse of that and put more capital in your penny stocks? Do you put as much capital in your penny stocks as you do in your mega cap tech companies? It's really easy to over allocate to risky companies. And you need to be aware that just because a company has a high payoff does not mean that it's high enough to adequately compensate you for how volatile it'll be over time. So for me, I take kind of a hybrid approach. I invest in some ETFs. I invest some portion of my portfolio algorithmically using a homegrown portfolio optimizer. I do some amount using equal weights. Generally, I won't put more than 1% of my portfolio in any speculative bet, and that's a handful of penny stocks, a couple of SPACs. It's just worth noting that the amount of capital that you need to put behind each trade is very much an art. That's something you should be very careful thinking about. And from experience, I can tell you it's easy to get excited about a new trade idea, start dollar cost averaging in, and then find out you've become way overinvested in a single name. So be careful. Think carefully about your portfolio. Think about the amount of risk you want to take and the amount of risk and volatility you're comfortable with. Be aware that as much as we've seen the stock market go nowhere but up since late March, there is no guarantee that's going to continue. In fact, I think the extreme odds are that it will not continue, at least through the end of this month. If not by the end of the year, I suspect that we will have some bad news that shakes the market to its core again. And be aware that you really need to be in it for the long haul. The best thing that you have on your side is time, but thinking carefully about how you want to allocate your capital and where you want to allocate it to has a drastic impact on your aggregate return over time. So if you like this, let me know in the comments below. I suspect nobody's watching, but would be pleasantly surprised if I was proven wrong. Like, subscribe, all that if you care to. I will try to put out videos on a weekly-ish basis if I can. And most importantly, just prepare for the future. There are lots of big catalysts coming out, macro and micro, across a number of industries. In the US, we have the election, which is going to be a meteor crashing into the market in many ways. And the best way you can be prepared is to have some dry powder in your coffers. Open up a trading account, a brokerage account. I tell everyone that to use Webull, like everyone else out there on YouTube. I have an affiliate link, whatever. You can use it if you want, but pick any broker. They're all fine, just not Robinhood. And good luck out there, and happy hunting.